Welcome to the Gray Report. I'm your host, Spencer Gray. And if you are a multifamily investor, aspiring investor, you're an industry insider, or you just love the idea of creating passive income, generational wealth, well, again, you got to strap in because we've got a great show today. We're doing another Gray Report newsletter roundup and recap, getting you up to speed on everything that happened in commercial real estate, multifamily, real estate, the economy, everything that happened this week. Again, if you didn't do anything else, you were living under a rock, didn't look at your phone, didn't read the news, we've got you covered. Everything that happened from A to Z in the world of commercial real estate and multifamily. Matt Bosnagel, he's back with us today. Again, he's the director of communications and marketing here at Gray Capital. I'm excited to bring him on again to kind of dive deep into what happened in the industry, in the newsletter. But first, just a quick word from our sponsor. This episode of The Gray Report is sponsored by The Gray Report newsletter, the premier weekly multifamily newsletter being delivered to your inbox every Thursday morning at 8:30. It comes packed full of the latest research reports, data, articles, original content, again, centered on the multifamily industry, but touches on commercial real estate, and the economy. So why don't you go check it out? Sign up at graycapitalllc.com/newsletter. That's graycapitalllc.com/newsletter. Once again, graycapitalllc.com/newsletter. All right, well, let's bring Matt into the conversation. Matt, it's been an interesting week. I know you're all vaccinated up. How you feeling? How you doing today, Matt?
Great. It's good to be back. Again, like I said, another great week, another busy week, and things are starting to move, really.
I feel like, and I've overused this, but I feel like the ground is moving underneath us with everything moving in terms of pricing. Everyone's talking about inflation. I mean, we're seeing it all around us. I mean, we're going to talk about that today. But yes, I was thinking this to myself earlier today. I think this is one of the most exciting times I've seen in the multifamily industry since I've really been involved in the past 6 years. So without further ado, Matt, bring us up to speed. What was going on in the Gray Report newsletter? What would everyone have seen if they received it this morning?
A lot about housing in demand. A lot about demand, really in general, for properties of all types that's really beginning to increase this week and really in this month in general. Demand from renters really is higher than expected. Demand from individual home buyers also, and really demand from investors is continuing to kind of bid up prices a lot larger than last year, and maybe a little bit larger than people would like this year. Investors have been a little bit more reserved maybe than home buyers, and are still able to find opportunities. But again, this is a competitive market. People are ready to buy, and demand is here in a very big way.
So it's interesting you say investors are reserved. I'm not seeing that at all, where there's any reservation from investors, because it seems like everyone's trying to get in before the inflation really takes off. But I think, as we've discussed previously, I think on the single family home space, if you're competing with somebody who's going to be living in a property, they don't care about the return. They might be able to pay a little bit more, but investors, they may be more well prepared. They can do a no contingency closing, and they may just be quicker to move. So I know it's definitely tightening things up a bit. All right, well, awesome. Let's just do a quick snapshot, rates and markets. Let's see where we are at today. The U.S. 10-year Treasury, it's up a little bit. We're at 1.65. It's been kind of hovering in that 1.5, 1.65 range. So, relatively flat. The 30-day LIBOR and SOFR, really no change. Kind of the shorter term maturity bonds, again, just not a lot of movement. In terms of financing rates, again, not a lot of movement, obviously correlated. Gold, steel, commodities, we still just see commodities continuing to just accelerate, whether it's crude oil, lumber, steel, cotton. I feel like I keep learning about a new commodity that is going through some kind of squeeze every single day. And then we also, of course, have cryptocurrencies, Bitcoin and Ethereum. Ethereum has been outpacing many other cryptocurrencies, especially Bitcoin, hitting all-time highs, really getting close to that 3,500 mark. And, again, it was around 1,000 only a couple of months ago. So a lot of movement with Ethereum, and what makes Ethereum a little bit more interesting is that there are all of these use cases, whether that be NFTs, smart contracts, a lot of the decentralized finance, a lot of discussion of putting even leases on NFTs on the blockchain. So a lot of interesting use cases being discussed, and so we've been tracking Ethereum pretty closely. All right, let's get into kind of the first section of the report. What's going on? Multifamily economy. Matt, what should we be looking at? What do you want to highlight today?
All right. So starting out, a lot of people, again, talking about inflation. I know I've got the highlight on the commodity, but I just wanted to foreground it with the comments from U.S. Secretary of Treasury Janet Yellen saying, quote, "It may be that interest rates will have to rise somewhat to make sure that our economy doesn't overheat, even though the additional spending is relatively small relative to the size of the economy." When the United States Secretary of Treasury makes a statement like this, you know that people are going to pay attention. And I think that the fact that she walked this back a few minutes later only further emphasizes the power of the idea that she's referencing here. It's getting harder to ignore the reality of inflation.
Yeah. Yeah. Well, I think that's the key. It's hard to ignore when you're seeing it all around us and everything that we're doing. And I know one of the other articles is, from Warren Buffett, Berkshire Hathaway meeting over the weekend, saying that, they're seeing on either end, their inputs and their outputs, what they're charging consumers, and people are paying it. But yeah, I mean, Janet Yellen, it's interesting because, she was obviously former chairman of the Federal Reserve. She was on the monetary policy side over at the Fed. Now she's in more fiscal policy over at Treasury. And, there's supposed to be this divide between monetary policy and fiscal policy, but she's been a major culprit of really mixing the two, and a proponent of mixing the two. And that's because central banks are out of tools. The toolkit, they've used just about everything besides, in the United States, negative interest rates. We've used quantitative easing. We've just used purchasing of assets, of all kinds of assets. Different ways of essentially printing money and loading up the balance sheet of the Federal Reserve. There's only so many things they can buy and they can do. And, fiscal policy, the federal government spending money on whether it's infrastructure, that's kind of the last piece they think that they need to put in place. But the Federal Reserve is not supposed to get into those fiscal matters. But now Janet Yellen is making comments on over to the monetary policy side over the Fed, saying maybe we need to raise interest rates, where Jerome Powell, the current chairman of the Federal Reserve, he's still saying they don't even want to thinking about raising interest rates, which makes that controversial. And they say they want to let it run hotter for longer. They want to see unemployment get down, kind of to pre-pandemic levels in that 4% range. I think we're still closer to 6%, but off of the highs of closer to 20% at the height of the pandemic. But what is it going to take to hit that now average of 2% inflation? And the fear is, are we going to overshoot it? And are we going to see much higher rates of inflation? We are seeing those higher prices throughout the economy. I've seen, quarterly GDP estimates, closer to 9 to 12%. Really, some crazy numbers that look like annualized numbers, but they're monthly or quarterly numbers. It's pretty incredible, to say the least. And yeah, sorry, go ahead, Matt.
Oh no, I think that in addition to the kind of federal the kind of Federal Reserve policy, the elevated commodity prices, which we've covered before in the Gray Report newsletter, those elevated prices are rippling through the economy, and it really gives a good picture of all of these of inflation kind of coming in all different directions.
Yeah.
Individuals are starting to become more active and spend more. Again, the government is pushing ambitious spending bills of their own. Inflation pressures are really coming at us from all sides. And it's, again, like I said, getting harder to ignore. I do want to note really quickly another article, because I like having different perspectives in the newsletter. And this one really does, I think it shows, it almost shows, it kind of undermines itself is all I can say. It's this article from Forbes, and it's talking about all of these. Every year there's an inflation prediction. Every year there's someone that's very worried about inflation. and it reminds the readers that the last time the core CPI exceeded 3% was in 1995, and it's a very compelling point with a lot of charts that begin with 1996 and tracking really all these missed inflation predictions. But I'm thinking 1995, that's not prehistory. So inflation has been here before. It's an exceptional event for sure, but it's happened before. And then I think about, well, what other exceptional once in a lifetime event has occurred this past year? And it makes it harder.
What could that be? Is it something happened in 2020?
I don't know. I can't think. But like I said,
The pandemic happened.
and this is not the same economy as 2016 or 2009. I don't think that it makes it harder to believe that we're going to get through this without some inflation.
Yeah, it's like, okay, $6 trillion, it's not going to have an effect. Supply bottlenecks, then there's no effect. And I think it's such a good point, Matt, of that, something is different. And we were, I think, joking the other day of, so many investors, economists, really smart people, sticking to this maxim. And I think of Howard Marks because he wrote a great book, Mastering the Market Cycle, where he talks about, everyone always says, this time is going to be different. But it really isn't. That history repeats itself. There are cycles, and sure, everything can be a little. The details can change a little bit, but cycles, they very much resonate, and they mirror similar patterns in the past. But you didn't have a pandemic happen, and the last so many cycles. You have to go back to 1918, the Spanish flu, to really kind of get a comp. But that was in a totally different time, less industrialized and less globalized world. So I usually I'd agree that, there's a lot of charlatans and people, selling snake oil, or just people like to make predictions of calling for hyperinflation every year, not without, bad reasoning, I guess. I mean, we did print a ton of money over the last decade, but nothing's compared to what we did last year in 2020.
Yeah.
So
I agree.
And Matt, and just on that, just to kind of drive that point home, we received a pretty interesting just image of a tear sheet from a distributor of building materials. This is dated April 30th, 2021. So this is pretty recent. And then the amount of increase on all of these line items. I mean, the lowest increase year over year is 5%, but many items are up 20%, 5 to 20%. And so, this is all the building materials, going into housing, and we're seeing 5 to 20% price increases across the board. We've seen just organically 12% year over year price increases of single family homes, slightly less, but a similar increase in multifamily assets depending on the market. But the question of, the idea of that if inflation is here is just, again, it's like the wrong question. It's here. It's just how much and for how long.
Yeah.
So, yeah. All right.
Agreed.
So let's move on to the next part of the Gray Report newsletter. What do you have for us, Matt? What's going on? Multifamily markets and reports.
Again, talking more about demand. These commercial real estate properties are in demand. But sellers are looking for kind of pre-pandemic prices. Investors are still not willing to pay those prices right now. And while that may be true in some areas, it also leaves open the possibility that investors comfortable with gateway markets are looking to smaller markets and creating more competition there.
Yeah.
Reading that article, it did seem a little bit at variance with what our own experiences are. I think that a lot of the discussion in that article was talking about commercial real estate properties as a whole, but I'd like to think that there is some limit to the amount that investors will bid up properties. And my gut feeling is that these people are, when gateway markets aren't doing so great, they're going to look elsewhere, and the kind of cap rate environment of gateway markets is going to start to maybe more closely resemble secondary and tertiary markets.
Yeah, that'll be interesting, and that'll certainly bring back some of those larger institutional investors that have kind of ventured out of the cozy New Yorks or wherever to find searching for yield essentially. But I agree. That's the investors and the buyers who are stuck on 2020 or really 2019 pre-pandemic prices. Well, they're not buying anything. Like that just full stop. You're not buying anything right now because you can't even be using 2021 prices. You have to be buying on, future growth right now. That's the only way that we see anyone winning any projects. Not that there aren't some very select off-market opportunities out there. I mean, we've been pursuing a few that kind of do have 2019 pre-pandemic pricing, but few and far between, and who knows if we'll actually be able to shake that one loose. So yeah, I think that if it's kind of comes back to that book, Who Moved My Cheese, and if you're still kind of using the same business plan, the same growth projections for 2021 and 2022, you're just not going to be able to participate in the market right now.
Yeah, and it seems like it's hard to make these predictions when 2020 was such a volatile and such an exceptional year.
Mm-hmm.
And I don't know if people are just going to erase that and look at 2019 and say, okay, we'll take those numbers and try to move them to 2021. But even then, it seems like the situation was ripe for increased demand and higher prices anyways. We weren't really building a huge amount of housing, and it seems like the market was ready for increases anyways. But I think that the pandemic has whatever the conditions were going to be, the pandemic has really kind of increased it to an extreme.
And like so many things about the pandemic, it just accelerated so many trends that were in motion, but may have really cut out a couple of years of kind of that timeline. And for real estate and housing, it's household formation, and all these millennials that make up like one of the largest demographic chunks. They're all of a sudden saying, okay, now's the time to move. Like, I'm ready for that next step, whether it's a bigger place to rent, a bigger place to buy. They're going to buy. They're making those decisions, and it's just a higher velocity of movement. People are moving around. And moving up, and the increase in single family home prices. There's an interesting article. I don't think it was on the newsletter, but it came out of Vox about basically these increase in home prices it's furthering that trend of us being a nation of renters, just because there's no choice. It's just you might want to buy a home, but you're priced out. It's not an affordable option, and you may be doing well, making a lot of money, but do you have the $75,000-$100,000 sitting there in cash to put down as a down payment, for that home? Even if you're making good money, you might not have that savings. So it'll be interesting.
And I keep thinking about the first-time home buyers. It's great if you have a house that you can take advantage if you already have a house that you've bought and you're paying mortgages on it, and you can sell it at these elevated rates, and then that'll help you buy a new one. But for people that are just entering the housing market, there's no way they can't. It's so much harder.
And even back in that Vox article, it had a couple of examples of people who it was discussing the problem of, even if you buy at the top, or even if you sell at the top, you still have to buy something. And it was people had sold their house looking to buy. They knew they wanted to sell, and they rented because while they were looking for something. Now all of a sudden prices are even more expensive than they thought, and they can't find anything. And I know a handful of people who they sold their house, and they're like, we're looking for something, but we can't find anything. There's nothing available. Things are crazy. Maybe we're just going to wait. And, we had a couple people move into our property over at Pinnacle on Meridian for that same reason. Like, we sold, but we don't know where to go. We need to find a place relatively temporarily. And will that temporary situation turn into a more permanent choice of, hey, let's just rent. Let's not worry about property taxes and maintenance and all that stuff. Let's just, keep things easy.
Oh, everyone that I know, I've had several people that I'm close with buy a house, and every story, it seems like a small miracle that they're able to find one at the right price. Yeah. And basically they were able to find something, period. So, yeah.
All right, let's move into policy and legislation. There's obviously a lot of discussion. We talked about taxes last week, so we probably don't need to get into a huge discussion of taxes. We'll see what happens when things move through committee. But Matt, it sounds like Cushman and Wakefield put out a really detailed and awesome report. Can you kind of take us through it a little bit?
Yeah, this Cushman and Wakefield report has a lot of great information with a number of charts that show you how the market is doing at a glance. both kind of specifically and in broad strokes. It's really more than a few paragraphs of educated speculation. There's some data here to back up their conclusions. On page 11, on the savings rate, shows the dry powder that's ready to enter the economy. You can see that there is a whole lot of money that's moving from savings to what I can only assume is spending. And really what I thought was interesting too is the information on immigration, which is later on in the report on maybe 25 or 26. I think this is particularly interesting in the context of the US population numbers that have been in discussion this week. And I can get to that in just a second. But I wanted to note that about immigration, population growth has been the lowest since 1790. That's been another. It wasn't in the newsletter specifically, but that's been in discussion this week. Is that our population growth has been very low. And 1790 is a very long time, at least to me. It's a lot. There's a lot more years between now and 1790 than now and 1995, if that puts it into context.
I think that's an important point, because, population growth, job growth, I mean, they're obvious the drivers of housing. And, when you see that the natural growth rate, from, births and, births compared to deaths, be decline. That's definitely a headwind for housing, and that's where seeing if immigration can kind of pick up. You do see the higher birth rates in the Southwest, higher percentage of Latin American immigrants to the United States that still have larger families on average, but in a lot of markets, it's slowing down. So if we don't have immigration, if people aren't migrating in, people just aren't having enough babies to keep up. So that's definitely something to watch. That's a much longer trend. But when we're looking at business plans that are 10 years long, I don't know how much these trends are going to affect that, but 20, 30 years, we often think about the possibility of holding some of these assets for beyond the 10-year hold period. So it's something to be tracking and making sure that you're in markets that aren't seeing that major decline for sure.
That's a very good point. Yeah, like I was going to say, immigration is fraught with political baggage. But if companies are straining to find talent, among other knock-on effects of low population growth, that could really change the equation when it comes to immigration policy. I know that there's other countries, you think about places like Japan, and they have all of these policies that would seem very strange in America, but for them, and especially the housing situation in Japan, if we're in a low growth situation and things continue along the same lines, then we may start having to look at Japan for.
Well, I think Japan and Europe. Europe has had a declining growth rate in terms of population for a long time. It's very kind of stagnant in terms of growth. And in Japan, it's been shrinking, a much older population. They're just not having kids. I mean, it's what happens in developed nations. And a lot of people are looking. I think Japan's a good point, because a lot of people are looking there to what they've done. It's been a little bit of a monetary experiments. They've kind of spearheaded, using negative interest rates and monetary policy to still drive growth. So far it seems like it's working relatively well. I mean, the yen is kind of keeping up its pace. It's still, Japanese economy seems to be doing okay. Not that I'm an expert in the Japanese economy, but I think that it's not in the kind of the dire situation it was before they used some of these kind of extreme monetary measures. But how does that all work out? When the population really does shrink to a very low level, I think there could still be some kind of fiscal cliff they could go off. But we've been in a monetary experiment for the past 115 years or so. So.
But that's a good point that you made, though. It's not just, you get low population growth. It's not just less people, but things shift to be older. And there's a whole, population growth is connected to such a wide variety of these kind of, I don't want to say externalities, but there's a wide variety of effects that these.
Old people, they don't spend money like young people do, in their 30s and 40s. Old people, they're looking for the, deal at the buffet, first thing in the morning. And like, they're not going on, trips all the time and buying a new car
Yeah.
and, buying new clothes. I mean, so yeah, it has a lot of interesting effects. So another major story that we need to touch on is the fact that a federal judge overturn the national eviction ban. I actually can't believe we didn't even talk about this first. I mean, this is like massive story. Probably should have been in the headline. Federal judge overturns national eviction ban. We've talked about evictions a lot. We've got a whole YouTube video about the eviction ban in different markets, how it's affected. I think we'll see, if this gets appealed. I think that it will certainly be appealed. Again, the property owners have criticized policy and say landlords can't afford to continue housing people for free. And I think that's where it comes down to. And I think that, we don't have to go back to the Cushman and Wakefield report, but it says, basically saying we're approaching herd immunity and we're getting out of this pandemic. Do we need a CDC national order that prevents, the normal course of business for housing, which is a key piece of, GDP and the economy. And if we don't have a functioning market for that key part of, GDP and the economy, how can we fully recover and how can we continue to maintain housing if we don't have a functioning housing market?
Yeah. Now I will take I'll take all blame for not bumping that up into the headline, but but I am curious. What do you think the effect is? And now I know it doesn't make it easy to do business with an eviction ban in place, and we have content specifically from Gray Capital that goes into the eviction ban and its effect on different multifamily markets. How strong of an effect do you think it has on the multifamily market? Does this make revenue, a full percentage point less, or what from your perspective, what is the effect of an eviction ban in a market, I guess, like Indianapolis?
So for like Indianapolis, I don't think it's going to affect markets like Indianapolis as much, where we have we've had the eviction ban, but we still have been able to essentially our courts have been open. We still have been able to file. Now individuals can file a CDC emergency declaration, which is kind of invoking the CDC ban. It can delay the process, but the reality is, there's so much rental assistance out there currently. There's federal rental assistance. There's local municipal rental assistance. There's private charities out there that are helping a lot of people. And so just for example, we had at one of our properties, we recently had two individuals. They filed CDC eviction declarations because they were behind on the rent. It sounds good. We're working with them. They're good residents. Besides, they just found in some hardship. They were immediately able to apply and receive rental assistance programs. Now that there's some bureaucracy depending on who the program is with in terms of when you actually get those payments, for how long. But I guess the CDC eviction moratorium was not only kicking the can down the road, but it was really it's a non-solution. It's really just kind of muds the waters, and it adds a lot of opaqueness and confusion for renters, for operators, because no one knows really what the rules are, because it's a ban, but you really have to declare under only certain circumstances, which are also kind of vague. It either reads like anyone could qualify or nobody could qualify for it. So I think just, again, having this functioning market, but there are assistance programs out there. So if you want to take advantage of them, those programs, do exist. And then, I haven't spoken to a single landlord, not that there aren't many out there, but I haven't spoken to one who isn't working with their residents. And as long as you make a good faith effort to kind of figure your situation out, no one's trying to put anybody, out on the street, which I think is good business sense. I think you have some of the smaller landlords who just, kind of more, fly by night kind of cowboy landlords who, that's my property, get out, you're a day late. That's just not good business. But, we should uphold contracts and, do the right thing and screen tenants but we want to build communities. We don't want to, just be putting people out on the street.
Yeah. It seems like what you're saying is that it does create so much uncertainty. Like you don't know if you qualify or not, which is basically risk. It makes it riskier. And I think we talked about this last week. The courts are going to be, there's going to be a lot of activity in the courts if about evictions and stuff, and it's
Well,
even
especially in
more.
the markets that just like weren't doing anything, like
Yeah,
Indianapolis, like, the courts have been open, but like in Minnesota, California, New York, yeah, there's going to be some bottlenecks, and that's just why mess with it. And that's why you see people, one of many reasons why you see people leaving New York and California. Okay, so let's dig into other commercial real estate news, commercial real estate markets. Again, I think we're really highlighting what's going on in the office market. It still seems to be kind of that bleak
yeah.
spot in commercial real estate.
I'm going to overshare a little bit, Spencer. While I was tossing and turning yesterday, recovering from my second COVID vaccine shot, I think that I had a dream about this chart, about this office chart.
Like a fever dream.
Yeah, it was a fever dream. The numbers for office for the, if you could scroll up and just, or I'm sorry, right there, that's fine. You can see that the demand for office is lower now. It's the quarterly numbers are the lowest that they've been forever. That's the vacancy rate is higher than it's been forever, and it seems like everyone's starting to shop more. Everyone's kind of getting out, and the recovery is starting to happen. But then you see this cliff that's even beginning to steepen. And so I don't know. Is this a nightmare for the office market?
Yeah, I think in many ways it is. I think people are kind of sitting on pins and needles, and it's the one area of major uncertainty, I think, in commercial real estate. I think, hospitality in hotels, people are like, okay, people are going to be traveling again.
Yeah.
Maybe business travel. I think that's, people feel a little bit more comfortable. Maybe it's not as robust as it was, but it's coming back. But office, you still have these conversations with people who are saying, I'm not returning to the office. I don't need the office space. Every attorney I speak to says, like, we don't need the office. Like, maybe we need a small meeting space, get together every once in a while, but I can read my briefs at home. That's very universal. I've heard from attorneys. Yeah. And it is interesting. Different industries are reacting differently. Real estate. I know most real estate offices, everybody's been in the office since last year. We're like, let's keep it going. But then, in the tech world, I saw another article this morning of, a tech founder saying that, their lease expired and they're not renewing and they're going 100% remote. And, I think that may be a little bit of an outlier. I think most businesses need like a physical space, but there's a lot of businesses who are just thinking about not renewing their office lease or downsizing. So yeah, it's not necessarily great for office. The counter argument from the office folks are that people are going to need more space in their office, so maybe you needed however many square feet per person. Maybe you need a little bit more square feet. I think that's kind of maybe a hopeful, wishful thinking, because if we're really out of the pandemic, yeah, maybe everyone wants a little bit more space, but how much, I think people are going to just want to. I think a lot of this is going to be past us in the next year or two, and we have very short-term memories, and we're going to slip back into old habits. Not that you won't see people on the street wearing a mask still, but.
That's what I was getting, like things about maybe a different office or they're going to want to move back to what it was before, hub and spoke, or a different, open, more spacious office. That may not be necessary. And I'm hoping it won't be necessary. And it will be much easier just to move back to the office than to kind of revamp an entire system of hub and spoke offices or something, some kind of thing that will mean a lot of work to be done to reorganize how the workplace is.
Yeah, no, I would agree. Okay. So the last section of the Gray Report newsletter, multifamily trends and technology. What's going on in the world of prop tech and multifamily?
So another article about blockchain. Last week there was one about a real estate company accepting rent in the form of crypto, and this is about blockchain and title companies. Now, I was doing a little bit more extra research on this, and I found articles from 2017 and 2018 about blockchain and title companies. And I think it's because blockchain is uniquely, almost inherently suited to establishing a chain of ownership. It's right there. It's in the public. When someone explains blockchain, that's like the first thing that they explain is that every transaction is public. You can find out when it is. If you have that information with you, then you can really establish. You don't need a whole company to establish it. But it seems like the challenge then is taking older properties and converting them in kind of digitizing them.
Getting the chain of title on
Yeah.
to the blockchain. Yeah.
Yeah.
No, I don't think title companies are loving this. I think you'll probably still need a title company to, even if it's to verify, maybe the blockchain, but maybe they're not going to be taking as much of a fee. But it's regardless of the role of title companies, it will transform the industry at some point. I think I believe it's a matter of when and not if. So I think that's fascinating.
Well, and like any technology, a good title company is going to want to probably try to learn how to use it. And maybe that means that they don't hire as many employees going forward. But I think it would be foolish for them to fight against it. And I don't think they are, as opposed to kind of, well, maybe some are fighting against it, but I think a smart title company would look and see how they can use this to their own ends.
Yeah, I think that's a good point, and I imagine the smart groups and the larger national firms will start incorporating it sooner rather than later. And again, I think a lot of opportunities with the blockchain, whether it's title, whether it's making paying your rent in cryptocurrency, whether that's doing operating agreements through smart contract, investments in crypto, all kinds of unique opportunities using the assets, digital assets in general.
Yeah.
So, all right. Well, that was a great kind of rundown of what was in the Gray Capital newsletter this week. Matt, again, awesome newsletter. I think the new format is much more digestible. I think it's really great. I know people are getting a lot of use out of it. I know our readership rates, increased quite a bit. But if you want to dive deeper, as you already are, into the Gray Capital newsletter, again, you can keep watching these recap videos released, every week, recapping what happened the previous week in multifamily, commercial real estate, the economy, and real estate. Hop on over to our YouTube channel, check those out. But also, while you're here listening to us, check out our blog, Gray Capital. We put out a blog. What is it, Matt? Every 2 weeks, we're usually putting off a blog post. And the most recent blog post is all about Indianapolis. It's all about, posing the question, and it's more of a statement, really. Indianapolis, it's the most underrated multifamily market in the United States. And essentially, it's not that Indianapolis is the fastest growing market, but it has very strong growth, very strong fundamentals, but yet there's still a little bit of a discount compared to similar markets, even inferior markets, providing a pretty unique opportunity, kind of exploiting the market inefficiencies. And, we go back and forth. Maybe we shouldn't tell anybody about this because we don't want the market to get flooded. But at the same time, we can't help but talk about how awesome it is and share the news. So, hop on over to graycapitalllc.com/blog. You can check out all the recent blog posts, check out this new article on Indianapolis. We take a deep dive into a recent report from Cushman and Wakefield, go through a lot of also charts and information from, a lot of other sources. So it's about multifamily, it's about the economy, fundamentals. Check it out. I think it's really interesting. And again, great job putting that together, Matt.
Thanks.
All right. That concludes the weekly recap of the Gray Report newsletter. This has been the Gray Report. I'm your host, Spencer Gray. And again, if you're interested in multifamily investing, you want to learn, you want to expand your portfolio, hop on over to graycapitalllc.com to learn more. If you want to take the next step, join our investment club, have an investment strategy session with one of our investment experts and associates. And in general, we want to get to know you better. So get in touch with us and keep an eye out for future episodes of the Gray Report and future editions of the Gray Report newsletter. I'm your host, Spencer Gray. Matt, again, it was awesome having you on the show.
Thanks.
Have a great day, everybody.
Thank you again.